From New York City for our viewers worldwide, I'm Sonali Basak, and Bloomberg Real Yield starts right now. Coming up, U.S. payrolls show an upside surprise, sending treasuries higher across the curve. And it's fueled bets on our December Fed rate cut. But we begin with the big issue, November payrolls showing a rebound.
This is a somewhat strong report, but not consistently strong.
You're seeing some moderate softening in what is a pretty solid labor report.
There are some cracks in the labor backdrop, but the floor is not falling out from beneath us here.
This is clearly just reiterating a gradual slowing in the labor markets.
The fact that the unemployment rate went up means that the Fed will be comfortable cutting by 25 basis points.
This is a kind of number that will support the Fed cutting rates in December.
With the unemployment rate ticking up a little bit, the Fed can go in December.
We're going to pivot to this, pause, skip debate and what kind of message that means.
It's hard to know precisely where the dust settles.
They're just going to continue to wait and see how the data unfold from here.
Now, even though payrolls came in hotter than expected, I want to look at this chart showing you the unemployment rate, because it's climbed 0.1% in November to 4.2%. If you round a little, it's even closer to 4.3%, indicating cooling demand for workers with long-term joblessness at the highest in almost 3 years, historically low, but still trending higher. If you take a look at the WIRP screen, with one Fed decision remaining in 2024, you now have a roughly 90% chance baked in markets of another cut in December, and there was roughly a 30% chance of another cut in January as well. But there is a lot of uncertainty, and though you see the pricing leading to more and more rate cuts, a lot of uncertainty left in the rest of 2025, particularly with economic policies still being weighed among the president-elect's economic team. But speaking of Fed rate cuts, Fed Chair Jerome Powell himself said earlier this week at the New York Times Deal Book Summit that the strength in the economy allows for a more cautious approach.
We're now on a path to bring rates back down to a more neutral level over time. But you're right, the economy is strong, and it's stronger than we thought it was going to be in September. So the labor market is better, and the downside risks appear to be less in the labor market. Growth is definitely stronger than we thought, and inflation is coming in a little higher. So the good news is that we can afford to be a little more cautious as we try to find neutral.
It's a lot to unpack, and joining us now, Oksana Aronov of JPMorgan, Gargi Chaudhuri of BlackRock, exactly the two people you're going to want to hear from on all the messy data. Oksana, you looked this morning, there was good news and bad news baked into the jobs data itself. What does it mean for how much room the Fed has to cut?
I just love listening to Powell trying to justify the unjustifiable, trying to justify keeping cutting at a time when we keep seeing strong data across the board. There is no muffled data. There is no uncertainty. We have a more normal labor market today, but it is by no means a weak labor market. We just went from extraordinarily tight labor market conditions, unprecedented so, to a more normal labor market. The Fed's own kind of target neutral labor or unemployment rate is 5%. We're far from it. 4.3 is a dream in any cycle. So every piece of data that has come in pretty much since the Fed started their cutting in September has been positive, and we've seen the initial reaction to their cut was actually a monster move up at the long end of the curve. And that's really what's important to remember, is that the Fed does not control what the long end does, what the 10-year does. The Fed has a pretty terrible track record of predicting where their Fed funds rate will be. We can see that from the dot plots moving around and never really being accurate. The market has a pretty terrible track record of knowing where the 10-year is going to be. We know that from the consensus that Bloomberg puts out every year and versus where the actuals actually fall. So, but if we take the market's word, and the market is pricing in a Fed funds rate of 3.5% for this time next year, and we know that the spread between Fed funds and 10-year historically is around 1.4%. Where does that place the 10-year? Above or below where it is today? That's the answer. That's the question.
Hang tight on that note. We will absolutely get to it. But I do want to see, Gargi, do you feel that way about the data the same way Oksana does, that this is strong and perhaps too strong to keep cutting?
Good afternoon, Sonali. It's great to be here. So a couple of points I wanted to make. Number one, this was definitely a normalizing labor market. Yes, absolutely, the headline number was strong. But as you pointed out in your opening comments, that the rise in unemployment rate is something that Chair Powell did pay attention to at the Dealbook Summit. And let's remember that the participation rate did drop. Had the participation rate not dropped over the past 2 months, the unemployment rate would have probably been a tad bit higher, quite a bit higher than where we are today. So that is something that we have to keep in mind. And I think that if you listen back or remember back to Chair Powell's comments from the New York Times Deal Summit, he did speak about how they went 50 basis points in September because of the data that they had gotten right before that, which presumably was the labor market data and the rise in unemployment rate. So I think this is a good print in terms of a normalizing labor market. To Oksana's point earlier, we're seeing several signs, especially with JOLTS and initial jobless claims, all of that showing a very solid labor market. But it's nowhere near where we were in 2023, where the average jobs created per month was about 100K more, or even 22. So all of this points to a Fed that I think absolutely should continue to normalize policy from the restrictive levels they're at. But at the same time, we're probably going to sit at a level of funds rate higher than what we had previously thought.
Now, love that spread makes a market. Promise you, Oksana, we will get to the 10-year because it's my favorite part of the conversation as well.
Let's even talk about the restrictive. I mean, I would love to have a conversation around that. What has been restrictive about these rates? We haven't seen it reflected in any part of the economy, not in housing, not in the stock market, not in the unemployment. Like, these rates have not been restrictive, and the Fed is reducing an already not restrictive level of policy rate, loosening financial conditions further.
Do you worry about inflation?
I think they're going to have to take some of this back next year. I mean, look, what we have is we are in the era of fiscal dominance, right? There's a tremendous amount of fiscal spending. We knew that was going to be the case irrespective of who was going to occupy the White House. And now we know that we have an administration coming in with probably more of an inflationary impulse. We don't know what they're going to do, but that seems to be the rhetoric, or at least what we can conclude, right? Mm-hmm. And we have all of this tremendous fiscal spending, which will continue to spur demand. So yes, I think inflation, not back to 9%, but an acceleration to the inflation figure is not a low probability event at all. And I think the Fed may find that they are still stuck in transitory right now, a little bit, and they're going to have to catch up with the reality of the data.
I want to also bring our audience some breaking news as well, because at the City Club of Cleveland, you have Cleveland Fed President Beth Hammack speaking in prepared remarks. And she's saying something like what you've said, that the data out between now and the meeting will shape the outlook, but we should keep policy modestly restrictive for some time. She sees currently one interest rate cut by the end of January, and that this is the operative statement here, that they're at or near the point where the Fed should slow rate cuts. Gargi, when we're thinking about the trajectory of inflation, you have to also factor in not just next year, as Oksana was talking about, but the underlying data we're even already seeing. You saw that wage growth in today's data. What does that tell you about inflation concerns heading forward?
Yeah, when you think about the wage data today, but not just that, right? When we look at the CPI data over the last couple of months, as well as the PCE data, some of that is showing a surprisingly strong resiliency, irritatingly strong level of inflation, sticky inflation that actually is going to be quite important for the Fed, especially in 2025, which is why the comment that I made earlier around rates are going to probably remain a lot higher than we had originally thought, like if we had the same conversation last year at this point. Obviously, there are risks. Many of them are associated with tariffs and immigration supply, et cetera, that could potentially lead to some pockets of inflation. But even if we look at just the data we've had so far, and you look at that goods inflation within CPI actually coming out of negative territory, going into positive territory, you look at that shelter inflation, particularly OER, that has remained a little bit stickier. I think all of those are great reasons for investors actually to consider some inflation-linked bond protection, especially at the short end of the curve, as a part of their portfolio. And I think we've seen a lot of investors doing exactly that.
You know, I'm really curious here. I want to go back to the 10-year part of the conversation. I think that is, to your point, the most important part. Where does the 10-year go next year? Is it higher or lower, Oksana?
So this is the question that everyone always asks and wants to know the answer to. And as I mentioned earlier, neither the market nor the Fed know. And the Fed doesn't even know where its neutral rate is, right? When they are asked, Powell sort of demurs, and the Chicago Fed president was like, well, we need to figure that out. Like, they don't know. And the reality is that as we look at the math, because bonds are all about math, we know that spread between Fed funds and the 10-year, historically, it fluctuated. It includes some very, very negatively sloping periods, right, for the curve over the last 10 years. But still, the average is at around 1.4%. And if you take market futures at their word and take 3.5% on the Fed funds, which is what the market's pricing in next year, I think it'll end up being higher. But let's assume it's there. And at 1.42, that gives you an almost 5% 10-year. That's a fair value if you wanted one.
Gargi, how much risk is there for you? It was interesting because on one hand, we spoke to everyone from JPMorgan to PIMCO to BlackRock about this. Your colleague, Rick Reeder, this morning saying that, you know, he's comfortable with the belly of the curve, staying shorter out, but looking further out, when can you even start to touch it?
Yeah, I think that, look, as of this moment, the fact that you're earning so much income in the belly of the curve, in the front end of the curve, and all of the risks that lie out there for increasing deficits that aren't going away anytime soon, in fact, increasing, right? You don't necessarily have a reason to own anything longer than, call it, the 5 to 7 year part of the curve, given the shape of the yield curve, given how much income you're able to generate just by being in the 5-year part of the curve. So it's not necessarily about, you know, what the exact level of the 10-year is. I don't think that's as important as the fact that you can build a perfectly resilient portfolio right now with income generation in the belly of the curve. You can earn that in the front end and in the belly. You don't need to go out. It's about need. Having said that, I do want to turn for just a second to the fact that as of today, we've had about $1 trillion in ETF inflows in the US. Huge day, obviously, for us. And a tremendous amount of that has actually come in fixed income ETFs. And a lot of that has gone into sort of things like IUSB, which is obviously focusing on the long end. So I do think there's a certain type of investor that always needs duration. You have to respect that. We're telling investors to focus on things like Bink that focuses more on the belly and on income generation.
Gargi, you have to leave it there. That is BlackRock's Gargi Chaudhuri and Oksana Aronov sticking with us for the next conversation about those credit markets. Up next, the auction block. We're going to check on credit and U.S. high-grade issuance for December, expected to be the busiest since 2021. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. It's time now for the auction block, where issuance has picked up after the holiday week in the United States. We're going to start with U.S. leveraged loans because that market has been busier than ever this week. Borrowers launching $100 billion of deals in a year-end rush, topping the prior weekly high of $78 billion set in 2020. There was a record 75 deals launched this week. And over in U.S. high grade, CVS, Tapestry, and Lockheed among notable sales, the week's total passing $23 billion, just short of estimates. New issuance is anticipated to slow down as the month progresses until the floodgates open back up in January. And in high yield, Hertz among the companies helping to jumpstart December sales after November had the slowest month since July of 2023, and it was the slowest November since 2018. And speaking of high yield, this week at the Bloomberg Intelligence Credit Conference, Kathy Jones warned that, quote, there is a sense now of real complacency that is priced into the market. It is priced as if nothing will ever go wrong. And despite spreads sitting at historic tights, Leslie Falconio of UBS is more optimistic in her outlook for high yield.
If the opportunity arises that high yields widen out, we would be opportunistic. Because we don't think you're going to be a recession, or we don't think spreads are going to, move materially wider.
Still with us, Oksana Aronov of JPMorgan, and joining the conversation now, Persson, CIO for Global Fixed Income at Nuveen. It's kind of like you look at the animal spirits in the equity market. You could say the same for debt. And it feels a little like silly season, I'm not going to lie, when people are just ignoring that anything can go wrong, global turmoil, and spreads are at ultra tights. Oksana, does that make sense?
Well, first of all, the equity market, the S&P specifically, and the high yield market have very little overlap, if any. So you really can't look at one and infer strength or weakness from there to the other. The junk market is highly reliant on finance markets, on being able to refinance themselves. These are not cash-rich companies. They do not have the kinds of business models that the S&P, particularly the main companies that are pulling the S&P forward, have, right? And yet, pricing is at an all-time tight, and you have double B high-yield yields sitting within a hair's distance of cash yields, essentially. And so you do continue to see people participate in that trade. I don't know why anyone would want to do that, but that's there. And look, we never know what the future is going to bring, right? Like, no one has a crystal ball, but we always know in fixed income when something is rich or cheap. In equities, you never know when something has reached some sort of, level of richness that cannot be surpassed. We've seen 52, 54. How many highs have we seen this year? In fixed income, it's all mathematically bound. And so when your spread gets this close to zero, essentially, you know that that's a point of vulnerability, and we really do not participate in that last mile because it inevitably ends very badly. And to someone's points earlier, they're going to be opportunistic if spreads widen. Well, how are you going to be opportunistic if you're all in here? That means you're going to have to sell something to buy something, and that's just not a smart way to invest on behalf of your...
Anders, for all those investors diving into high yield, what do you say to them? Are you part of that crowd, or do you look elsewhere?
No, I would say we're actually quite constructive on the credit markets. We're actually quite comfortable going below investment grade, given kind of the economic strength that we're seeing, given the low kind of default rates that we're expecting to continue going into next year. We are diversifying away from high yield into leveraged loans as well. You alluded to, record issuance on the leveraged loan side. I think the floating rate aspect of loans is a nice complement to high yield as well. I think some of the spread numbers you're referring to are obviously, something we're mindful about, and we don't see spreads going meaningfully tighter. We're also not seeing spreads going meaningfully wider either. I think another thing that we're mindful around is that the mix today for high yield in particular is very different than it was in the past. You have a much, much higher segment of high yield that's double B rated. So you want to be a little bit mindful of how you're comparing history for the high yield market at this point.
Well, it's interesting because not only is there high yield, there's leveraged loans as well, and you're seeing issuance just spike. And you're seeing almost still insatiable demand for things that are presumably riskier. So if you're looking for risk, where do you go, Oksana?
So if you're looking to add income and appreciation potential to your portfolio, right, you don't need to go into junk. You can, for example, clip a coupon in the high fives in the IG floating rate market, high quality corporate credit, and we are constructive on that type of corporate credit as well. High yield, the conversation around it having a different makeup today than it did in the past. I've always heard this throughout history in my 25 years in this industry, but it's never different. Whenever you have a canary in the coal mine somewhere, spreads go together, everything gets sold, and spreads move together wider. And let's not forget that today you have a tremendous triple B cloud hanging over high yield that is some of the larger names there are a threat, a downgrade threat, and that will have significant ramifications for high yield. So I just think when something is priced for nothing but blue skies, that is probably not the best time to be buying it. It's probably a time to take some chips off the table and go somewhere where you can pick up some yield safely, and definitely the front end of the curve, definitely the investment grade corporate floaters. And if something is priced euphorically, which we think high yield, certain areas of high yield certainly are, you can actually buy insurance very inexpensively and wait for that credit repricing, benefit from it, and then deploy into it.
Anders, it's interesting. You at Nuveen have sent us over your fixed income playbook for 2025, and I love some of these things: securitized credit, CMBS, esoterics, ABS, CLOs. When we start talking in the alphabet of fixed income, it gets to be a fun time. How much are you talking about this to investors? Does it take some convincing at this juncture?
No, I would actually say that I think investors are becoming more interested and even more sophisticated and are really looking for all kinds of ways to diversify, away from credit a little bit. So securitized offering, a different return profile, the diversification aspect from it, the correlation aspect from it. So to your point, we are finding opportunities throughout securitized credit and quite attractive high single digit kind of yield opportunities. CMBS being one key one that certainly was quite dislocated, has rallied back a bit, but there are still pockets there that we're finding good opportunities. ABS is a very fast growing area, a lot of new issuance going on. For instance, digital infrastructure is a space that we're seeing a lot more new issuance and finding a lot of opportunities. And then finally, CLOs, obviously sort of the sister asset class to leveraged loans. That's an area that I think we're finding really attractive risk reward. You're getting effectively, much higher rated kind of versions of leveraged loans, but at similar or even better yields and spreads. So I think our theme there and what we're hearing from clients is that they're really looking to diversify and looking beyond just traditional IG credit or even rates exposure. Fixed income right now.
We are out of time. I wish we could go even longer. Certainly a very complicated credit market that we are navigating. That is Oksana Aronov of JPMorgan and Anders Persson of Nuveen. And still ahead, the final spread the week ahead, because now we go from jobs to inflation. U.S. inflation data is very much in focus. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. It's time now for the final spread, the week ahead. Coming up, Monday, European finance ministers kick off their meeting, and Tuesday, earnings from TSMC and Bloomberg's Women, Money, and Power Conference. Wednesday's the big day, U.S. CPI along with more earnings, and Thursday, U.S. PPI and a rate decision from the European Central Bank. Friday is China's Central Economic Conference. And of course, we're going to be looking forward to that CPI. Remember, Bloomberg Real Yield, same time, same place next week. From New York, I'm Sonali Basak, and this is Bloomberg.